and welcome to this webinar on PGIM India Global Select Real Estate Securities Fund of Fund. It's my absolute pleasure to introduce my colleagues for this webinar today. I have here Rick Romano, who is the Managing Director at PGIM Real Estate and the Head of Global Real Estate Securities at PGIM. Rick has over 27 years of experience in real estate, both in the private and public markets, and have served in a variety of functions. He joined PGIM Real Estate way back in 1998 and has served on various investment committees and councils related to real estate. So it's great to have him here. And I also have Srinivas who may not need much introduction to all of you. He's our Chief Investment Officer, has over 25 years of experience, came to us from HDFC Mutual Fund, also has experience in infrastructure and real estate. And I hope that we can touch upon some very fascinating aspects of the opportunity in global real estate securities. But before I launch into my questions, I'd love to play a short video to introduce PGIM Real Estate to all of you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Wow, that was fantastic. I hope that you got a really good perspective on the breadth of experience and the work that happens at PGIM Real Estate globally. Welcome, Rick, to the webinar.
Thank you. Happy to be here.
Rick, can you take us through the journey of PGIM Real Estate and especially PGIM Real Estate Securities? It's been a long one and a fascinating one, but give us some of your key milestones.
Sure. PGIM Real Estate is one of the largest managers of commercial real estate globally. And that consists of private real estate strategies, it consists of private debt strategies, and it consists of the securities group. PGIM Real Estate started in 1970. It was one of the first managers to actually have commingled open-end investment funds in private real estate. And since then really has evolved to expand globally and has investment strategies in each major area or region in the world right now. The securities group I co-founded back in 2004, and that has really grown over the years to $4 billion in total assets across 4 different strategies: a select strategy, which is a concentrated strategy, a global core strategy, a US strategy, and an income strategy. And the benefit for us really being attached to this large global real estate investment manager is that when you look at the footprint of commercial real estate globally, about 95% of it's held privately, and only 5% is listed in traded equity exchange traded REITs. And so the insights that we get from our private real estate group are invaluable in terms of market rents, property valuations, management team reputations. It really helps us in our process to generate an information edge as we look at public companies.
Fantastic. Rick, I was going through some of the material that the team had sent across, and especially the 2021 Global Outlook for Real Estate. And it was fascinating to read that there are so many sub-themes within global real estate. For Indian investors and advisors, when we talk about real estate, it's almost always about either residential or commercial. But could you talk us through some of the various sub-themes and the consumer behavior shifts that are probably driving some of those themes?
One of the benefits of REITs is that you do have access in a very liquid, publicly tradable form of a lot of different property types in real estate. And that includes what we call non-core real estate, where the market is growing, they're not cyclical. So as you mentioned, when we think about real estate traditionally, we think about a lot of cyclical property types, whether it's office or retail. And some of those right now have, very difficult secular challenges that are occurring due to the pandemic, which will persist, whether it's work from home for office or whether it's disruption by e-commerce of bricks and mortar retail. Those are there and those are very real. The good news is that due to the number of property types that we have in the REIT world, there are property types that benefit from this change, and they're actually seeing tailwinds. So warehouse or industrial space is a great example of that. That technology, e-commerce, grocery e-commerce, it's all disrupting retail real estate to the benefit of warehouses. And that shirt that you had that sat at the mall or the shopping center now sits at a last mile distribution center before it gets delivered to your garage. Consumers want convenience. It's a convenience culture, and they're getting that through last mile distribution and by warehouse e-commerce disruption. Now, when you look at warehouse, the other thing that's really benefiting it is the supply chain crisis that we're seeing now with shortages and disruptions. That's only going to benefit warehouse as well. When you think about just-in-time inventory, we're going to move from just-in-time inventory to just-in-case inventory, and we're going to have to build out more warehouse space to avoid these sort of supply shortages and bottlenecks that we've had in the past. Another area that we've seen that really benefits from what's going on with the pandemic, the crisis, is data centers. Work from home, the demand for streaming services like Netflix or other streaming video services has skyrocketed during the pandemic. So demand and usage for data centers has really increased. And again, while work from home is a headwind long-term for office, it's benefiting data centers. We're seeing this in cell towers as well, where we're seeing 5G usage increase. There are cell tower REITs out there. So again, those markets are growing and they're not cyclical. So it's really a great opportunity to be involved in real estate right now, particularly listed real estate, because of all these options that you have to take advantage of these secular tailwinds that are out in the market. Another area, which I'm sure we'll touch on later, is how the housing market has changed. We've moved from a home ownership market to a renter by choice market. The consumer does not necessarily want to be tied down with home ownership, and they're looking to rent. And that will benefit certain sectors in real estate like single family rental. So really a great opportunity set that has really been accelerated, I would say, by the crisis, that these trends were out there, they were likely to occur. They've just been moved forward by what's happened with the pandemic.
Fascinating. Just in time to just in case inventory management changing so much of the dynamics that we know in real estate. And I came across so many terms during this pandemic that were new. I heard about revenge shopping and even revenge holidaying as we speak. It's difficult to get a hotel room in India as we're traveling around doing the roadshow for this fund of fund offer. Rick, you can access as an investor and as a manager real estate in different forms. Can you walk us through some of the key characteristics of REITs as an access?
I think when you think about REITs, you have to think about the income component. These are its investments in real estate companies that are landlords, essentially. So they're collecting rent checks from their tenants, which is getting passed through to the investor as income. So I think that's first and foremost in people's minds. Now, the other thing I think we should think about when we think about REITs is that that's not a fixed income payment. So unlike bonds, you really get this growth as you go forward. There's sort of a hybrid between bonds and stocks. And as landlords can increase rents over time, as supply and demand allows them to do that, they can really get really good income growth. So it's an income vehicle with growth attached to it, which often has a lot of inflation protection within that income stream. Because many times the leases themselves, the lease is structured to increase by inflation contractually on a yearly basis. So it really can give you some great protection against that. I think, other characteristics that we really like about REITs is when you think about real estate, historically, it has not been a very liquid asset class. You can't sell and get your cash very quickly. With REITs, there's absolute liquidity. They trade on major stock exchanges throughout the world. They're very large companies. They're part of large, broad equity indexes like the S&P 500. So you have great liquidity and you can get great diversification by investing in a REIT strategy. And you have the ability to shift that access or that diversification very quickly. So because they're liquid, as portfolio managers, we can shift our allocation between warehouse and apartments very quickly overnight. You can't do that in a private real estate strategy. So you have a lot of benefits that liquidity will give you in terms of tailoring your exposure on a daily basis, essentially, as to what you want to target and what has changed over the world to benefit the different property types. So, we think there's really a lot of benefits and characteristics that are beneficial and can actually be used in conjunction with the private real estate strategy to optimize your real estate investments.
Yes, Rick, this aspect of diversification is the one that most of us are responding to well over here as we speak to investors and advisors. Diversification in the real sense, away from equities and bonds to a whole new asset class, the real assets asset class. And the point that you touched upon, that this could be a sort of potential inflation hedge. Could you give us some more perspective around that? What's been the sort of historical evidence of that with rates?
Historically, real estate and REITs in particular have been great inflation hedges over time. So if you look back at periods of time where inflation has been rising, you'll see that real estate and REITs have done well and outperformed. And we really just have to look to this year in 2021, where we've seen inflation tick up, we've seen interest rates tick up, which historically, when interest rates go up, hasn't necessarily been great for real estate or REITs. But if interest rates are going up because there's more inflation in the environment and there's growth, real estate has done well. And this year, global REITs have been one of the top performing property types in the world. So we've seen 20% plus returns through the end of September for this asset class. And we're really, potentially in the, early innings of this inflationary cycle. We've had years and years and years without inflation. And the playbook as a result of that for chief investment officers has been to really make large allocations into fixed income assets. And what you're seeing here, to touch on your point of diversification, is that chief investment officers now looking at an environment that will be more inflationary than we've seen in a very long time, in many cases in their whole careers. And they're shifting the playbook as a result of that. As a result of inflation, we're seeing chief investment officers move capital from fixed income assets to assets that have inflation protection. And real estate fits that bill perfectly. It's got an income component, but that income component grows with inflation in many cases over time, because that's how the leases are structured. Many leases have inflationary escalations or bumps in their rent, but also you do have a lot of short-term leases where it's a monthly lease like self-storage, an annual lease like apartments. And in a rising inflation environment, landlords can adjust their pricing very quickly to take advantage of that. And then I think the last point that people don't necessarily fully appreciate when you think about inflation in real estate is that inflation really hits construction costs. And so you've seen the cost of materials go up globally significantly, whether it's lumber, whether it's steel. All of that means that it's more expensive to add new supply, which is great for existing landlords. If it's more expensive to build, you need higher rents to justify new build. So it puts a lot of pricing power and pressure on existing landlords. They can increase rents quickly. So for all those reasons, you really have great benefits in an inflationary environment. And when you think about the cost structure, if you're worried about wage inflation, when you look at real estate at the property level, many property types don't have a lot of labor costs. When you look at self-storage, there's usually very few employees, if any, at a facility. Apartments, what we've seen with the pandemic is that they've found ways to do things like virtual tours. All of this, how they've been operating during the pandemic has been deflationary to labor. They don't need as much staff to operate, they've found in the pandemic. So that's another benefit where your cost structure doesn't have too much inflation risk in most real estate property types. So for all those reasons, it's typically been a very good place to be during inflation.
The proposition really looks very, very interesting. Rick, tell me then, what are the risks, from a global fund manager's perspective, then when you consider rates at this juncture? What are the risks that the team is looking at?
We're always concerned about macro risk and geopolitical risk. And what we try to do to mitigate that risk is we really try to reduce macroeconomic risk. We try to reduce geopolitical risk in our portfolio construction process and asset allocation process. So we are real estate experts. So we should be able to tell you if a particular real estate company in the healthcare sector in the US is a better investment than either another healthcare company or an apartment company, right? That's a real estate apples to apples decision. So we don't take big overweights at the regional level, at the global regional level or the country level to mitigate what we think are the biggest risks in this space, which are geopolitical risk and macroeconomic risk. So we limit it very much that way. Other risks to consider, I think we can really diversify around company specific risks, whether it's development pipelines, whether it's balance sheet risk. We monitor all of those risks at the portfolio level and make sure that they're at appropriate levels. So the real estate risk we manage and factor in, and then it's really geopolitical risk, event risk, macroeconomic risk, which again, we try to account for in the portfolio construction process. Now, these are equities and they trade every single day in the market. So they're always going to be subject to some of the nuances in the market in terms of fund flows and whether the market is up or down that particular day. You'll have some volatility in this space as a result of that because they're traded every single day.
Right, and that brings me to the question before I move to Srini. I'd like to ask you one more question, which is around how would you recommend clients position this proposition? It's got fixed income-like characteristics, it's listed, it's got equity-like characteristics. So is there a specific way that you would recommend that clients think about it in their portfolio?
Yeah, it's a good question. It does have fixed income components. You do have that income component that we talked about, the higher dividend yield, but that's not fixed. It grows over time because rents grow over time, and you get rent growth, which usually leads to dividend growth that is at inflation or above. And as I said before, many of the leases actually have CPI escalators within the lease. So we think it's real estate. So when you look at the assets, the underlying assets, they're real estate. And even though they trade every single day like a stock, the properties, the cash flows are correlated 100% to private real estate. Now the value may have some correlation to the equity markets because of just daily flows and how people think about trading. But when you think about it relative to, I would say, fixed income and general equities, real estate and REITs, it's really a hybrid. It's got the income component, it's got the growth component, the capital appreciation component. And with REITs in particular, they are ongoing concerns. They're not just a fixed snapshot of their existing real estate. So they can go out and grow beyond their existing real estate snapshot through development, through acquiring companies or portfolios. And good management teams, good capital allocators can do that. And in many cases, you can see them really look more like an equity than a fixed income investment, even more than the hybrid would of traditional real estate. So because it's a hybrid, it has a great place in investors' portfolio because you're not getting something that's a hybrid really anywhere else. And that means that you're getting good diversification, you're getting a low correlation with your fixed income and your equity investment by being in REITs and by being in real estate.
That sounds good. And moving on to you, Srini, I know that you will have a few questions to ask of Rick as well. But before you ask your question, let me ask you a question, which is, from your experience, what would you say is the real benefit for Indian investors here investing in REITs?
Real estate is an important asset class. If you see, Indians love real estate and they love to own physical assets. As you can see from the significant share in the savings that real estate has at this point of time. So I don't think we are debating about the real estate as an asset class. Your question on REIT, India, unfortunately, owning a real estate is quite complex. It is complex in other geographies as well. Whereas in equities and equity funds, everything is electronic. So that's the advantage of owning equity funds. REITs will give you best of both worlds. So through REIT, you're getting exposure to real estate. At the same time, having hassle-free buying and selling, which is as good as equities, as everything is electronic and REIT. Also, when you own a real estate, you tend to depend more on capital appreciation in India, less on yield. Whereas by owning a REIT, you are having both income generation and also participating in the capital appreciation. So I think it's a great product to have. I think Indian investors would love to have REIT in their asset allocation.
All right, Rick, my next question is to you, and this is more related to ESG, and we saw that in the video that we played, that ESG is probably quite a well-developed concept in the real estate segment. How is this working globally, and can you walk us through how the team looks at incorporating this in the real estate securities portfolio?
ESG is an important part of our process. We take each company in our investment universe and we assign them an ESG score. And that includes proprietary analysis of corporate governance. And then it also includes evaluations of environmental and social issues at the company. What we do with that score is we roll it up to the portfolio level. And one of the things that we want to make sure of is that when we roll up our ESG score at the portfolio level, we want to make sure we have a stronger ESG portfolio than the index, than the investment universe or benchmark. The other thing that we do with ESG is we've incorporated it into our price target. So we do what I would call a real estate value of each company. So we value the real estate, and we really leverage off of that large infrastructure of our private real estate group to get to a very proprietary value of the real estate. But importantly, we don't stop there. We make adjustments off of that real estate value because these companies are ongoing concerns, right? They may trade above their real estate value. They may trade below it for various reasons. But one of the adjustments that we make to get to our target stock price is ESG. Is this company, do they have great disclosure around ESG? Are they taking the right steps to be carbon footprint neutral, by the appropriate time period? And then more importantly, what will the capital expenditure requirements look like to get their properties to, whether it's government regulation standards or tenant need standards around ESG? So we'll make adjustments on capital spending as we underwrite these companies, as we value the real estate, to make sure that we're appropriately accounting for the spend or the dollars that are going to have to go into the properties to get them to be at an ESG level that is going to be compliant with regulators' needs, with tenant and market demands and shifts. So we really attack it, three different ways. We attack it at the portfolio level, we attack it at the price target level where we adjust, and then we attack it at the real estate level where how much capital is going to be needed to get this to a compliant state.
And if you were to just dive into the select portfolio as well, the select real estate portfolio, can you walk us through, sort of the broad geographical and sectoral overweights, underweights, and a little bit of your rationale on the key aspects of that?
From a geographical region perspective, we limit those overweights to plus or minus 2%. And that goes back to the biggest risks that we see in this space, which is really being able to mitigate or control risks around geopolitical events, risks around macroeconomics. So we could very much feel confident that we could get the real estate correct between, say, Asia and the US. We could get fundamental supply and demand correct. We can get all of that right, but there could be a geopolitical event or a macroeconomic event which could cause the companies to trade differently than where the real estate fundamentals are going. So for that reason, we have slight overweights or underweights at the regional level. Right now, we are seeing opportunities in the US, so we have a slight overweight there. We're slightly underweight Asia right now, and we're neutral Europe. And the Asia underweight is really primarily due to Hong Kong. We saw what happened with Evergrande and some of the Chinese property developers. We don't own any of those and never have, but in Hong Kong, there's always some spillover effect to what happens in China, even though the Hong Kong developers don't have exposure to the Chinese banks that Evergrande does. But more importantly, within Hong Kong, there's a common prosperity bill. And this gets back to, again, shortages of affordable housing across the world. And what the government there is trying to do is sort of limit developer profits on residential properties. So that's an overhang, and that sort of explains our more strategic underweight to Asia is really the Hong Kong underweight right now. When you look at property types, there are really three themes that we're seeing out there right now that we're taking advantage of and that are great for active management. So you've got reflation, what you've talked about. So the reintroduction of inflation for the first time in a long time, certain property types that benefit from that I'll talk about. Reopening, as we move past the Delta variant and really get to a more robust reopening. You mentioned revenge travel. All of those things we think are going to come back very robustly. And revenge travel had been leisure. There's going to be business revenge travel. People want to get out and travel for business and see clients. And then what we're calling recalibration. And that's really how is technology transforming real estate to create winners and losers, whether it's things like artificial intelligence that can be used to make better pricing or revenue management decisions by real estate landlords, whether it's artificial intelligence, which could help them identify better development sites or acquisition opportunities or markets. All of that is coming into play right now and creating winners and losers in the space. So in the reflationary theme, we really like self-storage right now. When you think about self-storage, it's got a 30-day lease. It's really benefiting from all the dislocation that's occurring right now due to the pandemic. So the pandemic has created movement. It's created people moving out of urban areas to suburban areas and maybe moving back in many cases. All of that dislocation creates opportunity for self-storage. And again, in the operating cost perspective, self-storage doesn't really have any property level employees, so no wage inflation to worry about. Really tight supply and demand at the top line means rental growth. Housing, that's always benefited from a reflationary environment. So shorter term leases, usually a year or so. And as we see the cost to build go up, construction costs go up, we're really seeing landlords able to push pricing power there. So that's been an area that's benefited. Reopening, we like hotels. You mentioned revenge travel. We definitely saw that in the summer. We think the next wave is going to be in 2022, where we start to see office travel start to pick up or business travel start to pick up. Pent-up demand for people to go to group events, to meetings, conventions, client visits, all of that will start to come back with pent-up demand, which will be great for hotels. And hotels are not trading at a level that really reflects what's to come right now. Assisted living, there's a pent-up demand for needs-based healthcare, and a lot of assisted living is needs-based healthcare. And we're seeing, while during the pandemic, occupancy was down significantly, we're seeing all that pent-up demand come back, occupancies ticking up and continuing to beat estimates of where investors think occupancy would be and rate would be. So that's a great opportunity for us right now. On the recalibration side, we're seeing industrial companies like some of the larger global industrial companies really using their large database of intel, of artificial intelligence, and being able to go out and really create better revenue pricing models and create the ability for them to drive more cash flow to their existing properties through better pricing decisions on rents. And that's creating winners and losers in that space. So we've had some success with some companies there that are taking advantage of that. So there's really no shortage of opportunities right now in the world, with not only the dislocation of what COVID had brought to bear, but the reflationary environment and this just transformational recalibration that's going on in the space.
So reflation, reopening, and recalibration, that's a nice way, that's three themes to look at how it's building into the portfolio. Thank you, Rick. I have quite a few questions coming in from our partners and our audience, and I'll take some of those questions, and hopefully we'll get further perspective on the subject. So I'm going to start with the first question, which is, you spoke about behavioral shifts that are actually driving a lot of aspects of real estate globally. Is the team seeing any permanent shifts which are likely to have an impact on the different types of rates?
One of the permanent shifts that we think is likely to persist, or one of the shifts due to the pandemic that is likely to persist, is an element of work from home in the office place. It had not been really tried before to the scale that it was tested during the pandemic. And the reality for many companies is that it worked, and it benefited employers in terms of productivity didn't really go down in many cases. In some cases, it actually increased for employees. And ultimately, there'll be some cost savings to the employer for their office needs. And then when you look at the impact on the environment, we touched on ESG, but the fact that people will be using less transportation to get to their office is just a net benefit from an ESG perspective. So there's social aspects, and also for working mothers, there's social aspects for them having more flexibility in their schedule, or working fathers to have more flexibility in their schedule to work from home. So all of that, we think, results in some level of permanent shift to a hybrid where maybe, the new office model is not 5 days a week, it's 3 or 4 days a week. So while that is going to be a headwind to office over the next few years, we do think well-located Class A office that really has the right ESG, the right environmental components to it, newer build, will continue to do well. But we do think other areas that are benefiting from the work from home trend within REITs, like data centers, like cell towers, will continue to get demand going forward as this fully evolves. We think that when you think about retail and the disruption from e-commerce, that is a permanent shift. That's not likely to end anytime soon. We're not in the late innings of that necessarily. We still think that there's certainly disruption that will continue to occur on that front. And then this shift on housing, how people think about housing, that you don't necessarily need to own your home. You want flexibility built in. While you have the money to pay for a home, you might want flexibility, you might want mobility. So I think that's affected a bit how people think about, how they're going to live, where they're going to live. And work from home will affect where people are going to live. You don't necessarily need to live in a dense city. If you want to, that's great. You have access to all those cultural amenities. But if you don't, you can live, out in an area that, is commutable 1 or 2 days a week. Or if you're fully work from home, you can live anywhere you want, really. So I think those are, big disruptors that are going to shape the landscape of real estate for the next 5 years. And it creates great opportunities for active investors and active management who can take advantage of those trends and changes that are to occur.
Rick, another question here is that, you spoke about the fact that 95% of real estate is really privately owned, with about 5% and growing in rates. Now, from an institutional investor or a high net worth investor's perspective, are you seeing shifts in fund flows within asset allocations of these sophisticated investors, or even for that matter, individual investors into this category globally? Any evidence of that?
2021, we did see some very strong fund flows from both individual investors, institutional investors around the REIT space. REITs underperformed in 2020 in the pandemic because the pandemic hit right at the heart of where we live, work, and play. So real estate was very much affected. But as we moved to 2021 and we started to see a reopening and reflation, we started to see many institutional investors, many retail investors get very interested in the space. And so we've had one of our strongest years in recent memory and positive fund flows into the space. And a lot of it is that investors have been so anchored to fixed income investments for so long, because that has been the right thing to do in this low inflation, low interest rate environment, that they have in 2021 started to shift out of that into this more hybrid asset class like real estate that has inflation protection. It's got the dividend yield, the income component. It's got inflationary protection within the leases, and then the ability to raise rents. So we have definitely seen renewed interest in the space in 2021. And when you look at 2022 and look at the landscape for inflation and rates, it still looks like a good opportunity, and investors are still, the search activity from institutional investors is increasing.
That's very comforting to know. I'm sure to advisors and investors here as well. I can see a couple of questions coming up for Srini, but before that, Rick, one more question about the investment process. And at the early part of the conversation, you spoke about the real-time proprietary access to the private real estate information for the group. And we saw that in the video, 1,500 plus securities, maybe more than 4,000 odd properties. Can you walk us through how that helps really in creating value for clients, and in what ways would you use it for even risk mitigation?
Being attached to this large private real estate group, where we know that 95% of commercial real estate is held on this private side, gives us really unique access and benefits and insights into really what's going on in that very large piece of the real estate universe. When you look just at the public markets, you're only seeing a small slice of what's occurring because it's really about 5% of the universe. So we utilize our private real estate group to get great insights on where are values today. So what are they underwriting? What are they paying specifically for certain types of real estate across the world? We can use that real-time information into our valuations of the public companies. So that's one way where we think we really get proprietary real estate values and analysis from our private side group. Really, another important thing of real estate is where are the fund flows going? So if we know our private real estate group is investing in, for example, a non-core property type for the first time in their history, we know that other institutions are going to be doing that too, and that's going to be really good for the value of a non-core property type. So we saw that in the past few years when our private real estate group invested in manufactured housing, and we saw cap rate compression, meaning values go up in the US as institutional capital came into that space. So that was, very important for us to see that look. And then I would say they give us really good insights because we can be a lender, we can be an equity partner to all of these management teams. We get great access to the management teams, but also we get great insights into who are the better management teams, who can add value, who are the best in their market at developing, at acquiring, at managing real estate. We have in PGIM Real Estate, we have a group who's had a lot of experience with any of these REITs really across the world. So that gives us tremendous insights in underwriting the management team, which is very important for our process. And then the last thing I'd say, the last benefit is that PGIM Real Estate is very focused on technology and using that to, again, help aid investment decisions in real estate. So we're able to look at what we're doing on the private real estate side and ask the right questions to the REITs as to how are they using technology to separate themselves, to differentiate themselves. So that's been a great look for us as well. So really many different ways that really just add to our information edge or information ratio in the space by being attached to that large private real estate group.
As we were having early conversations about the fund with our investors and advisors, in fact, that deep experience and expertise of the team was what most people responded to and felt confident about. I have more questions for you, Rick, but I can see one here for Srini. Srini, can you tell us about the Indian experience around rates and investing in rates?
Indian experience is mixed and evolving. Why I'm saying this is, though the REIT regulation is in place for many years, the first REIT that has happened is only in 2019. Even there, the initial reaction was somewhat skeptical. But as people realized the full benefits of REITs, we've seen in that particular REIT 50% rally in the stock price over 6 to 12 months. As I think there was a talk about interest rate coming down and people got excited about owning a REIT. And then COVID happened and we've seen about 30-40% correction in the REIT. As the occupancy levels have fallen a bit, and as a result, the outflow has been a bit lower. Overall, I would say it is still evolving. I think people understand now the benefit of owning a REIT. But at the same time, as Rick rightly mentioned, this is a hybrid product. This is neither equity nor debt. I think that will take some more time to sink in.
I guess then the timing of a global real estate securities fund is good, as we can bring in more clients to experience this at the global level. Rick, one other question that we've received here is about the different return characteristics of rates that you spoke about, and Srini just spoke about the fact that it is like a hybrid between fixed income and equity. Are these are the drivers of the return and risk very different across the three major regions that the team tracks?
When you look at variations of returns and risk profiles across the world, I think one of the things that we really focus on is transparency and reporting and access to management teams. And those parts of the world where you have a little bit less transparency or less frequent earnings reports or less access to management teams, those are areas where we think the risk profile is a little bit higher and you should get rewarded with a higher return as a result of that. Now, the good news is what I touched on before, because we have this large private real estate component, is that we can get an information advantage if there's a part of the world where disclosure and reporting and transparency is less clear, because we are digging down through our private real estate group to really get a clear picture on what's happening in that real estate market. I think a good example of that is Japan, where they report twice a year only earnings, and access to management teams historically for investors has not been, they have not been as accessible as they've been in other parts of the world. So that's a great opportunity for us. But again, we want to be compensated with a higher return because that risk profile is going to be different. In Australia, you have great disclosure, great access, good reporting. So, we look at that as a much more transparent market. We can still use our information edge in those markets to get good insights as to, what the REIT management teams are doing and saying relative to what's really happening. And same thing in other parts of the world, whether it's the US or Europe, where Europe is probably in between in some of the, transparency and access to management teams. We can really, leverage our resources and navigate through the different return and risk profiles across these regions to drive good results. And then the only thing I'd add beyond that is some markets are a bit more yield focused because the characteristics of their real estate may be more income oriented. So a lot of investors will look at the 10-year bond within that country and where real estate is trading relative to that as one of their more primary valuation metrics. But in most cases, people are looking at not just the real estate yield, they're looking at the growth component to really come up with the valuation.
I'm really tempted to ask this question as I'm seeing it come through, which is about, you spoke about investments in Asia Pac and about not being exposed to China or the crisis that we saw with Evergrande. Design or default?
It's a bit by design. As I mentioned before, I think it's a bit by design in that we are really looking for, areas where we can get good disclosure, good access for the most part. If we can't get it from the public companies, we want to get it through our private side. So even on the private side, I think the access and exposure within some markets is difficult. And we've tended not to invest in those markets where we don't feel like we can get an information edge. And for us, China really fits in that bucket where it was harder for us to get a good information edge. So we've stayed away from it. And as a result, it's been, a good decision for us, given the volatility that we've seen there, some of the debt issues that we've seen there.
That's good to know. I'm at my last question, and I know that Srini is also probably, got a couple of, maybe a question or two for you, Rick. But my last question is really to both of you that I've got from the audience, which is the aspect of real estate being a potential inflation hedge. What's been the house view around inflation, Rick, and the team globally? And Srini, you can add after that about what do you think about that here? Rick, maybe you can go first.
I think there's a big debate right now whether this inflationary period is transitory or whether it's a bit more permanent going forward. And, when you look at all of the stimulus that's been thrown into the system throughout the world, and then you look at some of the fiscal policies around the world to sort of, rebuild infrastructure and things like that, that typically will mean that, we do have more inflation as a result of that. So that's going to take a while to work through the system. So, we think that inflation is going to be here to stay for a little while as we work through not only the stimulus, but all of the a lot of the infrastructure rebuild that we're seeing across the world. And then ultimately, we can get to a period where that corrects a bit. But we think inflation will be here to stay for at least the next 2 to 3 years. And that I think managers really have to start to think about that as they position themselves within asset classes, across asset classes and across geographies. Who are going to be the beneficiaries of the inflationary environment needs to be a theme that investors start to really think about in the next few years.
Ajit, we in India don't have that concern or worry, whether inflation is transitory or not. Inflation is always there in India. So it's a reality that we've been dealing with for many years. So also in India, let's understand the equity as an asset class is very, very recent. And even today, only 5-6% of Indians have exposure to equities or equity mutual funds. So historically, only way to beat inflation has been real estate. And people look at empirical evidence. If you bought house 10 years, 20 years ago versus today, we all can see the change in the housing prices. So I think people have been doing by default in India in terms of owning a real estate. But I think as an investment, it had its own challenges. As we evolve, now we will have something like REIT, which is a far superior asset class.
Lovely. That brings me to the end of my questions. Srini, if you have a question or so for Rick, and then we can close.
Yeah, sure. Rick, I have a question on the yield. So as I see the yield, current yield for the product is about 2.2%. What has been the historical range and how did this evolve over a period of time? Also, when I'm seeing in India, the yield on residential asset class is about 2% versus about 6% for commercial. Also, what is the relation between GSEC yield versus REIT yield? If you can take us through on this.
Historically, we've seen global commercial real estate dividend yields, and this is the yield at the fund level, run anywhere from say 2 to 5% or so, depending on. One of the big drivers, as you point out in your question, is where are government yields at the time. Many people do look at the spread between where government 10-year yields are trading and where the real estate dividend yield is or the real estate cash flow yield is as one metric. And what you'll find is that the yields are typically lower when you have the potential or the forecast for higher periods of rental growth. Because again, these are a hybrid, they're a total return vehicle. So you'll have lower yields when you have higher growth expectations like you do now, and higher yields when you have lower growth expectations like you might towards the end of a cycle or in potential a recessionary period. So I think the relationship that we're seeing right now is quite normal, and we would even say relative to government bond yields, the spread that we're seeing, which in many parts of the world is over 300 basis points on the cash flow yield of real estate, is more attractive than it's been historically. In other parts of the world outside of India, the residential vehicles tend to yield a bit more than 2%, but the commercial yield is a bit lower than 6%. So you see, some differences across the world based on the property type that you're in right now. And I think the residential component, while it's higher than 2, it still is relatively low because there is generally, people are thinking that there is good rent growth on the residential side that's to come going forward. Where we're seeing higher yields are areas that probably have some secular headwinds. So office, you could definitely find office companies throughout the world that are yielding 6 or 7%. You can certainly find malls or retail shopping centers that are yielding 8% or so. But again, be careful, buyer beware, because there might not be much growth attached to that, or there could be negative growth attached to that and values going down. So yield and dividend is an important metric, but it's not the only metric. And we really need to think about the total return prospects for these companies. And that's really what we focus on primarily in Select. We do look for good income, strong income coverage, but we really want to see what is the full picture, what is the total return potential for this company.
Thank you, Rick. Over to you, Ajit.
Well, thank you, gentlemen. That brings us to the close of this webinar. I hope, ladies and gentlemen, you enjoyed that conversation and got some great perspective around global real estate. Over the course of the next many days and weeks, you will have opportunity to get more information around this new product launch of the PGIM India Global Select Real Estate Securities Fund of Fund. Thank you very much, Rick, for joining us today and sharing your perspective with us. I'm sure that in a different time, as things normalize, we will see you here in India soon. And thank you, Srini.
Thank you. Thank you, Rick.
Thank you. Thank you for the time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.